Hello and welcome to Market Domination Overtime. We're getting a fresh look at how traders are positioning now into year end with the new Stacks report from Charles Schwab. The Stacks Index, which tracks the sentiment of retail investors, jumped into an 8-month high in November. For more, we're bringing in now Joe Mazzola, head trading and derivative strategist at Charles Schwab. Joe, great to see you. So let's start right there, Joe. So the Stacks hitting an 8-month high here. What does that suggest to you, Joe, about risk appetite as we're heading into year end?
So let me put it in context, Josh, because at an eighth month high, it's still about the 65th, 66th percentile. So we're not in that nosebleed FOMO territory that you might have seen back in 2021. So it's bullish. But one thing interesting about this past month, Josh, is that only 2 of the 11 sectors actually had net buying, which is odd because you saw IT, you saw consumer discretionaries, and basically everything else saw net sells. So people were rotating out of some of the cyclical names into more of these the narrow leadership. It was the Mag 7, which like I said, I find interesting because it kind of flies in the face of what you saw with the overall market, where you had healthcare leadership, you had financials, you had utilities, materials that were kind of moving the market. But what we noticed is that the 5 main stocks, or even just the top 3, whether it was Nvidia, Palantir, Meta, they all shared something in common. They all had a 20% pullback during the month, and our clients jumped in and used that as an opportunity to buy.
In terms of what they were buying, Joe, you're kind of going leading me where I was going there, because I saw here, it did look, Joe, like a lot of sort of AI-heavy tech names. So I see Nvidia, Meta, I think Tesla, Amazon, Palantir. Yep. I mean, when you see that, Joe, is that just kind of tactical trading, or no, that's more firm sort of renewed belief in the AI theme and trend?
I'm going to lean towards tactical a little bit. I'm going to lean towards using opportunities, pullbacks to 50, 200-day moving averages, pullbacks, like I said, of 20%. From all-time highs, as clients saying, look, we've been waiting for opportunities to get into these names. They're getting relatively cheaper. And remember, even with all of these names, they all had good earnings. It wasn't like they missed on certain targets. It was, for the most part, when you dug through the financial statements, or you had the post earnings call. It was, hey, we're spending a little bit more than maybe we were expected on AI. And so some of the companies that had those type of announcements were punished, Meta being one. And so when clients got an opportunity to kind of scoop those up, they did. And the reason I say tactical as well, too, is because a perfect example would be Tesla. So Tesla, pulled back just shy of 20% of the month. Clients bought it, but then that was actually one of the top 2 stocks that they sold at the end of the month when they got that nice little rally back. So it was interesting there. And then the flip side is, if you look at the stocks that were sold, Apple, Broadcom, Eli Lilly, Rivian, Intel, these are all stocks that actually had really good months. Clients use those as opportunities to trim. I mean, perfect example would be something like Eli Lilly, rallied from 850 to 1110 or something like that. But if you're looking from a technical standpoint, Josh, it's like an 86 RSI. It's not something you see very often, and as opposed to kind of piling on and chasing the winners, they trimmed into strength. So I think that was pretty prudent.
What do you make, Joe, switching gears a bit here, of just the very high conviction that investors have the Fed is going to cut this week, Joe? I did have one strategist on recently. I know what you make of this. He kind of was making down, but he thinks that conviction is mispriced. He's not as certain of cuts coming, given where inflation is at. But what do you think?
I think when you head into a Fed meeting with conviction this strong, Fed Chair Powell in the past has not shown a willingness to go against that strength and conviction. Now, what he might do, and this is what I think a lot of us are predicting he will do, is he'll say, here's your cut. Don't expect any, in the near term while we wait for more data to come out. We do get some inflation data this week, but it's October data. So there's still stuff for us to kind of parse through as we're moving towards the next meeting in January. But I think the belief is there will be a hawkish cut. And when I look at kind of what our traders and investors are telling us, the traders feel really strongly that there'll be a cut. The investors are a little bit less inclined to believe that. But when I just look at the history of Fed Chair Powell, and you see something as strong as an 85, 90% likelihood of a cut based upon kind of what the markets are trading right now, he tends not to go against the grain. But who knows? Now they said it. Watch, this will be the first time, right?
I'll get you out of here on this, Joe. I'm just curious, what do you make of those who argue the Fed is, in some sense, if they cut this week, they're risking their credibility, Joe, in that you're cutting even as inflation is above target, and 2%, they'll say, listen, that's a target, that's not a suggestion. So either decide, hey, it's not really 2% and say it's 2 to 3, or don't cut. I'm just curious what you make of that argument.
I think that's a fair argument. I really do, and I think that they probably are thinking about that as well. I think maybe the difference would be this. It's not necessarily looking at the target in the near term. It's this belief that they can get there eventually. And I think that's probably what the markets are pricing. And Josh, I think what you're getting at is a debate that's been taking place, basically for the majority of the year is, can we get there towards those inflation targets while we're still cutting, or while we're having the end of quantitative tightening, or while we're having an accommodating Fed at this point? Because the belief is that now that there's other undercurrents, whether it's tariffs or whether it's the change in employment, which is kind of cut what we've seen in terms of labor supply. So that has kept the unemployment number a little bit lower. But you have the Fed that's got these two competing priorities, and they're really supposed to be focusing on both, and it's a difficult position. And what I think investors are saying right now is, we think you'll figure it out, and we're willing to own equities while we're waiting for that. But yeah, I mean, I think if there's a shock in terms of maybe there's a little bit of over hawkishness, or however you want to state that, that could cause a little bit of volatility. I think this, given what we have, not only with the Fed meeting, but we think about this, Josh. We also have Oracle, we have Broadcom, we have those earnings that are coming up as well too. So there could be some volatility at the end of the week for sure.
You got some big names, Joe. As always, great to have you on the show. Thank you, sir.
Thank you, Josh.
EV maker Tesla getting hit with a downgrade at Morgan Stanley. It's a reversal from a prior bullish position. Here with a closer look is Yahoo Finance's Praz Sumrain. Praz.
Yeah, so Morgan Stanley, Adam Jonas, he's still at the firm, but he's now doing more of a broader, I think, robotics and physical AI type research. So now new analyst Andrew Percoca sort of reversing here, slightly bearish on Tesla, going to equal weight from overweight, which Jonas had before, citing valuation challenges, basically saying the high expectations of the AI kind of trade are already priced into the stock. But he did raise the price target up a bit here, following some of the parts evaluation, looking at the fact that they're not putting in the robotics business as I think it's $60 into that stock price more, and sort of bringing back some of the auto business down just a tad. So wanted to say that they're not totally bearish on the stock. They have an $860 bull case in long term there, and he advises long-term shareholders, look, there's an attractive risk reward here, citing their sort of AI sort of endeavors like robotaxis, FSD, which a lot of people are talking about the news version being quite good actually, and then robotics, of course. All
right, so that's Tesla. What about the broader auto industry outlook 2026? Yeah. What do you see?
We're seeing a lot of the banks and a lot of the strategy firms putting out their outlooks for 2026 and for the auto sector in particular. I think, not in any particular order, but number one, EVs. Is there concern there? Is there see a big takedown because of the loss of the tax credit? Some are saying a 20% hit could be the possible move there with EV business, and a lot of companies are going to start scaling back there, which could benefit companies like Tesla and Rivian, ironically, because they're pure play, and people might say, hey, they might be a better product, might be better pricing. It's the big companies that might get out. Another big thing is affordability. We're talking about car prices going up way, way, way high, above $50,000. Is there going to be an addressing there with regards to the lower end of the market? Trump was talking about this, about companies making smaller cars, and that is a good thing, but that's going to take time for the market to do that. So it's rates, it's prices, it's EV outlook. There's concern that the market might shrink next year because of the fact that it was an uncertain sort of lookout with the consumer and also pricing.
For sure, Frost. Thank you, buddy. Appreciate it. Coming up, is the housing market poised for a turnaround? We get insight from the CEO of AI mortgage lender Better.com. That's next on Market Domination Overtime. It's gearing up to be a big week for the financial sector, from the Fed to a key industry conference and developments in Washington. And senior reporter David Hollerith is here with more. David.
Hey Josh, so this week, beginning tomorrow and then also Wednesday, we have Goldman Sachs is hosting a very large financial services conference. And we're going to hear from all the larger bank CEOs, along with a bunch of other CEOs in the financial sector. And this is really their last chance to give thoughts in terms of their quarter and also the year. Now, to that point, large bank stocks closed at all-time highs on Friday. So we're looking at, compared to a year ago when investors were pretty optimistic, at what's on pace to be a very good year for large banks.
So while we have you, David, by the way, you have a meeting on the Hill on Thursday. It's all things crypto. What's going on there?
So there's a report earlier today, and we have reached out to a trade association for some of the largest banks, and it's reported that some CEOs are meeting with lawmakers to discuss the crypto market structure bill. Now, that's really important for banks and even more so for the crypto industry. And what they want to talk about is essentially, I guess what you would say, bank permissibility, what banks would be able to do. Now, they're obviously already heavily regulated, so that kind of sounds to me like it's a little bit about what will this bill allow anyone in the crypto market to do that will also allow us to do things too. So they're probably looking for some pretty consistent language with the Bank Secrecy Act, and that might not be something that the crypto industry wants to hear, so that's been a continual debate going on right now.
All right, David, thank you, buddy. Appreciate it. The Fed is expected to make one last interest rate cut before the end of the year. This may help keep mortgage rates lower, aiding the overall sentiment of the housing market, potentially entering a more balanced phase in 2026. Here with a closer look, we got Vishal Garg, CEO of Better.com, a digital home finance company. Vishal, great to see you. So let's start there with the Fed. We do think, listen, a cut, investors are betting, is on deck by 25. If they do that, Vishal, I'm just curious, let's say they cut by 25. What's the effect on the 30-year fixed, which right now Mortgage News Daily says is about 6.36.
Yeah, so 6.36 probably goes down to 6.15, 6.1. Could go lower, depends on what happens, what the Fed says, are the reasons for why it cut. And if they kind of give a bearish outlook, you could see the rates go down to 6, 5.75. And that could unlock a lot of savings, because every quarter point rate cut is basically $1,000 a year in someone's pocket. In an average family's pocket. And so that's really meaningful in times like this when inflation is high. And if you've got the ability to save, then you should rush in and look at it.
Can we already quantify, Vishal, how much the drop is already translated into savings for Americans?
Yeah, so a quarter point rate cut on a $400,000 mortgage, right, is about $1,000 a year. And then as you keep going from there, the savings become bigger and bigger.
So let's we gotta zoom out here. Let's say we're talking 12 months now, Vishal. Do you think 2026 for the U.S. housing market, would you expect, it's going to be about the same as 2025, a bit worse, a bit better? I asked, I've had a range of housing economists on the show. You throw two economists, you get three opinions. What do you think?
I think rates are going to be about a point lower. So I think the 6% rate goes down to about a 5% rate.
You do?
Yeah. I think the economy is not doing as well as people think it is. I think consumption is really in the top 10% of the country is holding it up, and that's because the stock market is high and people are sitting on massive gains in their stock portfolio, so they're spending those gains.
Yeah.
I think if the stocks stall, I think unemployment goes up. If the AI data center boom, it's like we have had no GDP growth if you take the AI data center stuff out.
But the counter to that, Vishal, I hear that a lot, right? If we take out, but we do have the AI data center boom.
And people are topping out.
Yeah.
People are topping out. It kind of feels like the AI story is like a little bit like 2000, 2001 in terms of
You hear echoes there.
Yeah, I see it. I was there.
Yeah. What are the echoes you hear, Vishal?
I think people are building AI data centers like people were building bandwidth and laying cables back in 99 or 2000. And I think that doesn't mean that the effects of AI throughout the economy, like e-commerce really took off 3-4 years after the AI, the e-commerce .com boom ended. So e-commerce took off in 2003, 4, 5, right? The savings from AI are going to be extraordinary. In our business, it takes us $3,000 to make a mortgage with AI that it takes a bank $15,000 to make. And that number, I tell people, is going from $3,000 to $1,000, and we're going to take all that savings and give it back to customers. And so that's going to be a lot of savings in people's pockets, but those savings are coming in the next couple of years ahead. And so I think you're going to see the housing sector really boom. I think you're going to see refinances become a real thing. I think people need the money. I think inflation remains stubbornly high. I think unemployment is creeping up. And I think financial security amongst American families is at near all-time lows. And so I think people are going to really need that rate cut for a typical homeowner to kind of get either enter into the housing market or to refinance and take that savings and be able to spend on it elsewhere.
How many people, before you buy a home, obviously, you take into account all kinds of things, right? So it's a 30-year fix, but it's how you feel about the economy, the labor market, how secure your job is. So would that suggest, okay, in 2026, a lot more people are going to stay put?
Yeah, but 20 million people literally got pre-approved to go buy a house in the past 3 years, and they missed buying one in 2020, 2021, and household formation's been happening. They've been benefiting from what's happening in the economy, and those people, they need a place to live. And I think so. Basically, they're stalled right now. They're renters, and rents have been continuing to go up. So they need the security of a 30-year fixed rate mortgage where your housing payment stays the same for 30 years.
Let me ask you a little bit more about your business. You run this AI-powered mortgage lender. Can you just explain to us, how is your business model, how is it different, Vishal, than what an average traditional mortgage company?
So we don't have all the offices around the country. We don't have branches. We don't have all of the fixed costs that are required there. We don't have the huge amounts of commission loan officers. So what we don't have is we don't have all that. We have AI taking care of a lot of that. We don't have the crazy back office, thousands and thousands of people doing processing and underwriting a mortgage. The AI handles all that. All that does is it makes our cost to make a mortgage about 80% lower than a big bank's and about 60% lower than your typical mortgage lender down the street. And now our business is thriving because what we're doing is not just on better.com, letting customers get a cheaper rate and a faster mortgage, save time and money by coming to better.com, but we're not taking that technology and rolling it out to other fintech, to other banks, to other mortgage companies so they can make their businesses better. And that has led to a boom in our business. Our business is double what it was last year. We're expecting it to double again next year. And so we're pretty pumped for what AI can do for us.
Can I ask you, who's your average customer, Vishal? Who's the demo? Is it different than a traditional mortgage company?
No, I mean, the average consumer is actually someone who's not well serviced by like a private wealth management group at Citibank or Chase or Wells Fargo. The average customer of ours is someone who is comfortable with technology, is buying a $400,000 house, putting down about 12% down, has a decent credit score, not amazing, like 720 credit score, and has a debt-to-income ratio in the sort of 35 to 40% range, and they're just a good average American family trying to buy a house and get into a home, and savings matters to them. So like a Costco shopper.
I have seen you, Vishal. I've seen and heard your company compared to Figure. How do you compare and contrast there?
I think what Figure does, and they're great, they've been doing it for 7 years. They're a leading home equity finance company. They let people take equity out of their homes and get a second lien mortgage on it. And they use it to pay back their debts or to make a home renovation. We have come out in the past 18 months. We are the fastest growing home equity finance company. And again, what we're doing is Figure is basically making the loan and securitizing it. They hold on to it. We have built an AI-powered marketplace of a whole range of investors. And by doing that, we're able to give customers a lower rate than Figure and a higher approval rate than Figure because we go out to the entire investor market and we find an investor that matches your criteria. And so our approval rates are 2, 3, 4 times that of Figure's. And that's why we're winning. That's why we're growing 6x faster than they are now.
Let me ask you, I'll get you out of this because we're going into year end. I have to ask you, last I checked, your stock was up like more than 400% this year. How much time as a CEO do you spend thinking about that, looking at that stock chart?
I don't think about it at all.
You don't?
I want to help more customers.
Yeah.
I want to push the AI to do more. I want to save more money for our customers. I want to lower our interest rates. I want to get more investors on the platform. All I care about is lowering rates and giving back our customers time that they can spend with their families. That's what I spend my time thinking about.
Vishal, great to have you on the show today, especially on set. Thank you, sir.
Thank you so much.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned. So read.